So tonight we're doing leases, which is fine. I think it's a hard chapter because you have so many steps. But if you do a lot of practice problems, it's always the same thing that comes up. So like all the chapters, the more you do practice, the better you get at it. So for leases, a lease is for companies is the same as a lease in your day-to-day life. If you have a lease for the rent of your apartment, well, you enter into a contract agreement with your landlord, which allows you in exchange of payments to use the apartment for a period of time. Same thing with the companies, except the lease could be applied to any type of assets. It could be a building, it could be equipment, machinery, a plant, like any asset that a company has, they can lease it to someone else in exchange for a payment. So the right to use the asset is provided in return from a payment from the person who leases, well, who rents the assets. There's two types of leases for companies. There's the one where you capitalize the assets and the other one where you expense the assets. So finance capital lease are the same, and that's where the lessee is going to come and capitalize their assets that they're renting, and the lessor, so the person who originally owned the asset and that's letting another party rent it, is going to be deemed to have made a sale on that asset when they enter to the contract. So it's a capital lease under ASPE and a finance lease under IFRS, but they're accounted for the same way. Whereas an operating lease, what's going to happen is that the lessee is going to, instead of putting as an asset in their books, they're just going to expense all their payments. So it's going to come and reduce their net income. The lessor, on their hand, is that they're going to have a revenue in their net income. So it's going to come and increase it. You need to determine both for the lessee and the lessor, because it could be a finance lease for the lessee and a capital, well, and an operating lease for the lessor. Also, the lessee could be using IFRS and the lessor could be using ASPE. So that's where, that's why we're doing, oh, you guys couldn't see my screen before? Do you guys see my screen? Just to be sure, because I had that.
We can see the screen.
Yeah, we can see the screen. It's fine.
Okay, thank you. I had like a weird message popping up. All right. So yeah, you need to determine if it's a capital lease or an operating lease for both the lessee and the lessor. The criteria for a finance lease for the lessee, finance lease is under IFRS. So all baseline, all the leases under IFRS are capitalized. So they're all finance lease, unless the lessee elects to not to have an operating lease. To have an operating lease, the lease must be short-term, so less than a year. So it's not a big impact on the statements. And it needs to be less than a 5,000 minimum lease payment for the year, because it's not material. It's not a big amount, so they can pass it under their expenses. The criteria for a capital lease for a lessee, so that's the criteria under ASPE, is they need to fulfill one of the three criteria here. The first one is, do they have the option to buy the asset that they're renting at a lower price than its fair market value at the end of the term of the contract? Or do they keep the ownership of the asset when the leasing contract is done? So if the answer is yes, then it's a capital lease. Second thing is the lease term, so the term of the contract, at least 75% of the useful life of the asset? If the answer is yes, it's a capital lease. N is the present value of the minimum lease payment. So the payment that they're making every year, well, every term of payment, at least 90% of the fair value of the asset when they enter into the agreement. And if the answer is yes, then it's a capital lease. So they could fulfill all three or just one, and it would be a capital lease. So how do you calculate the present value of the minimum lease payment? I put the criteria here, like all the information, but it's your present value formula. And for the N, you're putting the lease term, the future value. If you have a bargain purchase option, so if you can buy it at a lower price, or a guaranteed residual value at the end of the contract term, you're going to put that amount there. If you have an unguaranteed residual value, then your then your future value is equal to 0. So you're just going to put 0 there. For the rate to take, under ASPE, you're going to take the lower of the lesser rate or the lessee rate. So if they have two different rates, one's 10%, one's 8%, you're taking the 8%. And under IFRS is if the lessee knows the lessor's rate, they're going to use that. And if they don't, they're going to use their own interest rate. The payment is the amount that they're paying during the year. It's often given, and if it's not given, then you have the present value that's given. So you need, from your payment, you need to remove any executory costs before calculating it. Executory costs could be administrative expenses for the lease that they're repaying to the lessor. It's normally very clear if there's any in the problems. And then you find the present value. So if that value is more than 90% of the fair market value of the asset, then you have a capital lease. Under IFRS, for the lessor, it's the same criteria as for the lessee. So they have to elect to have an operating lease. And the two criteria are the same. For ASPE, same three criteria as we just saw, but the lessor needs to fulfill also the following two criteria. So they must have these two fulfilled, like yes, yes, for sure, to have a capital lease. If they don't fulfill it, but they fulfill one of the other three, it doesn't count. It's going to be an operating lease. First thing is that they expect reasonably predictable payments from their lessee, and they know if there's going to be any future costs to be incurred linked with that lease contract. The lessor also, once the lessor has a finance or a capital lease, you have to find if it's a sales type or a direct financing lease. So that adds to it because that's going to impact your journal entry. A sales type is going to happen when the book value of your asset is smaller than your fair market value of the asset that you're going to rent to the lessee. What that happens is that because you have a finance lease, if you're under IFRS, you're deemed to have sold the assets when you enter into the agreement. So you remove it from your books and you're going to have some revenues. Because of that, if the difference between your book value and your fair market value is different, you're going to have a profit. And that creates a sales type lease, like in the name. If not, if your book value is equal to the fair market value, then you have a direct financing lease. You're more going to be tested on under a sales type lease for the lessor. Well, yeah. And I've put here how to account for a direct financing lease. I'm going to try and find a problem for the final review that talks about the journal entries for these. But it's pretty similar to the sales type. It's just that you're not subtracting the inventory and the cost of goods sold in your journal entry. And then the journal entries, will do them together for the problems that I posted. And thank you, Simon, for letting me know that I didn't post the right questions on Facebook. I think I was sleeping when I posted them. I don't know. All right, so question 1. On January 1st, 2008, Canadair Jets Inc. enters into a 4-year non-cancelable lease agreement to lease original jet planes to Canuck Airlines, with payments required at the end of each year. The following information relates to this agreement. The airplane cost Canadair Jets $17.6 million. On the date of the lease, it has an estimated fair market value of $20 million and a useful life of 5 years with 0 residual value at the end of that time due to technological obsolescence. Executory costs of $132,000 annually related to the leased plane will be initially paid by Canadair Jets and collected from Canuck Airlines. So what that means is that, well, the lessor is Canadair and the lessee is Canuck. So Canadair is renting their assets to Canucks, and they're going to have some expenses linked with that airplane that they're renting. So they're going to pay it first, and then when Canuck is going to make their payments, then they're going to add the amount of executory costs that Canadair paid during the year. So Canadair, it's like as if they didn't pay anything. The annual year-end lease payment set will allow Canadair Jets to earn an 8% return on its investment. When the plane will revert to Canadair Jets at the end of the 4-year period, it's estimated to carry a fair market value of $4 million, though there is no guarantee from Canuck regarding this value. So here, it's an unguaranteed residual value. IFRS applies to Canadair Jets and ASCII to Canuck Airlines. Both companies have a December 31st year-end date. So section A, so we're going to first do all the entries for Canadair Jets, so for the lessor. Indicate the type of lease Canadair Jets has entered into. So, question 1. Canadair so first, what we need to know is that Canadair is a lessor. And they use IFRS. So under IFRS, if you remember, they need to elect to have an operating lease. Here, there's no mention that they elected, but we could check and see if they fulfill the criteria for it. So the first thing is it a short-term lease? Less than a year. If we look back, the lease term was 4 years. Yeah, it's a 4-year years lease terms. Sorry, I don't know what's going on today with my English. So it's a long-term lease. So, no. And 2, is the minimum lease payment less than $5,000 per year? And we're going to find that out. So we're going to need to compute it because they don't give us the amount of minimum lease payment right ahead. So how you calculate it is your N is your lease terms of 4 years. Your interest rate, they are using IFRS, so they're going to be under the lessor. So they're going to be using their own rate, which is 8% here. The future value is, so since they're the lessor, we're going to include it. So regardless if it's unguaranteed or guaranteed, we're going to include the $4 million as their future value. We're going to see for the lessee, this is going to change. So and if they have the bargain purchase option at the end, you also include it here. the payment we're going to find, and the present value. Well, they have a fair market value of 20 million. So that's our present value here. So my payment amount is you have to be careful here with the end of period versus beginning of the period, because sometimes it could be a beginning of the period when they make the payments at January 1st instead of December 31st. So just be careful about that. But here it's at the end of each year, so it's going to be end of period. So that gives us a present minimum lease payment each year of $5 million. So that's really bigger than 5K. So no, it doesn't fulfill it. So it's a finance lease. Now it's the lesser. So we have to check, is it a sales type or a direct financing lease? So remember, to be a sales type, your fair market value of the assets need to be greater than the book value of the asset. So the book value in the books of Canadair is 17.6 million. And the fair market value is 20 million. So you have a profit of 2.4. So it's a sales type. So you're going to be recognizing well, it's going to be deemed as a sale when you do your journal entry, and you're going to have to remove the asset from your inventory. All right. So we did one. So it's the finance lease and sales type. So two, we're going to have to determine the total annual installment which Canadair Jet seeks to receive from the lease contract. So that means that how much money every year is Canadair going to get from CANUC for their lease agreement. First amount that you want to find is the minimum lease payment, the annual minimum lease payment, and you want also to find is there any executory cost that the lessee needs to pay to the lessor. So here we already found our minimum lease payment amount, which was the 5 million here.
With just one question, what is the sell type again? Because it's the face market value is bigger than the book value.
Exactly, there's a profit. If the book value was 20 million, then there will be no profit and it would be a direct financing lease.
And if the book value was bigger than the face market value?
Sorry?
If the book value was bigger than the fair market value?
Well, that wouldn't, I haven't seen that in any problems and in real life, but I think it would also be a direct financing.
Okay.
So you have your minimum lease payment, and then you're gonna see, is there any executory costs I'm gonna receive from the lessee? And the answer is yes, it's 132,000. So see here, when we calculated our payment, it didn't include any executory cost. So no executory cost. This is only for the lease portion. You're adding the executory cost to the amount of payment that you're going to receive from your lessee. So the payment, really cash money that you're receiving from the lessee every year is 5,282,000, 5,282,000. So that's the payment that they're going to receive. Then we're going to prepare the journal entries on January 1st, 2008 and December 31st, 2009. So on January 1st, 2008, what happened is that they entered into the lease contract. First, what you want to account for is the lease payment receivable that the lessor is going to receive over the 4 years of the contract. How you find that amount is your minimum lease payment times the number of payment terms plus any unguaranteed residual value or guaranteed residual value or bargain purchase option. So here, my minimum lease payment, MLP, I'm going to just say that because it's easier to say, my MLP was $5,150,000. My number of terms was 4 years. So that gives me 20 million, and I need to come and add my unguaranteed residual value, which was 4 million. Then I want to come and include my cost of goods sold. And this amount is the book value minus the PV amount of my unguaranteed residual value. Yeah, if you have a guaranteed residual value or a BPO, I've seen, like, it's not really clear in the textbook, and I've seen in the solution that there's 2 ways. You can either like just put the book value, or you can do the same thing and subtract the present value. So it's whichever you're more comfortable with to do. So here, my book value of the asset that we're renting is 17.6 million. And we need to find the present value of my unguaranteed residual value. So I'm going to do a amortization table here. Well, I'm going to do the calculation here. So my N is 4. My interest rate is 8%. My future value, so when the contract is going to end, it's unguaranteed, but the residual value should be 4 million. So that's what I'm going to put as my future value. And the present value is $2.9 million. So I'm going to come in and subtract that from my 17.6 million. Then I have my sales amount. The sales amount is going to be the present value of my payment plus any, well, I'm going to write here. It's the PV of the MLP plus any guaranteed residual value or BPO minus the PV of the unguaranteed residual value. So here is going to be the present value of my minimum lease payments, which was 20 million. It's 20 million because it's the same as the fair market value of the asset. That's what we use to calculate it. Minus the 2.9 million here that we found, which is the present value of the unguaranteed residual value. All right, after that, you have a decrease in your, well, assets or inventory, depends how they account for it, but if you put either or, it's fine. And that's going to be the cost of the asset. And then you're going to have unearned interest income, which is a plug amount. So it's the difference between your debit and your credits. And you can also find it by doing an amortization table and finding the sum of your interest expense. So we're going to do the amortization table because it's going to be helpful while we do the future journal entries, and you're going to be able to see like where that 4.6 million comes from. So I'll do it here. Oops. I'll do it just under because you can see the full transaction. All right. So we're gonna have our dates, the annual, well, your minimum lease payment, interest, have a reduction and your lease obligation, well, receivable. Right, so on January 1st, 2008, your lease receivable is 20 million. So it's 20 million. This is the present value of your asset. Well, sorry, the fair market value of your asset / the present value of your minimum lease payment.
Just one question, quick. How did you get the sales? I can't seem to get the right number.
Yeah, I did the present value of my minimum lease payment, which was 20 million, minus the present value of my unguaranteed residual value, which is a 2.9.
Then what did you roll to the present value of the minimum lease payment plus the GRV minus that? Because
So-
I did that and it's not giving me that number.
No, well, here we don't have any guaranteed or bargain purchase option. So here would be 0. Because in a problem, you're either going to have this one or this one or this one. You're not going to have all 3. So that's why I added them, because we're not going to do all the journal entries for all the options. So here is only the 20 million. So the present value of your MLP minus the present value of your unguaranteed residual value.
Oh, okay, but then you put the arrow to the cost of goods sold. You put like right above that. Yeah, what did that arrow mean? Like you said,
If you have the guaranteed residual value or a BPO, well, I guess I can change it. It would be like either your present value of your unguaranteed residual value, or your guaranteed, or your BPO. I guess also.
Yeah, that makes more sense because I thought that arrow meant that number equals.
No, sorry, my bad. No, it's one of the 3. Okay, so here you put your 20 million. Then you're gonna have on December 31st, 2008, you're gonna receive your first payment from the lessee. And we're only looking at the lease. So we're gonna exclude any executory costs. And that payment amount is the 5.1 million that we found earlier. We're gonna calculate an interest of 8% on that amount. Oh, sorry, no, we're gonna come and calculate an 8% on my 20 million here. Just like we did interest expense like a lot of weeks ago, which is gonna be a reduction in the lease of the difference of the 2. So of 3.5 million. So at December 31st, 2008, you're gonna come and decrease your lease receivable to 16 million. Then on December 31st, 2009, it's going to be the same thing, same amount of MLP. Your interest is calculated on the same value, same thing. And then I'll do the rest. Right, so you see at the end here, that number is familiar, right? That number is the 4 million of unguaranteed residual value that we had earlier. So the 4.6 million comes from the sum of all your interest payments that you're going to receive and that you're going to get as interest income. So makes sense that we put it as unearned because we're going to receive it in the future. All right, on December 31st, 2009, you received the payment from the lessee, and you record your interest income for the year. So here it's going to be, I guess I could put it a little bit bigger. Here it's going to be this line here that we're going to look at. So first I'm going to receive the payment from the lessee. So it's cash, and it's going to be the 5.282. You're going to have a decrease in your lease payment receivable of 5.15, and you're going to have executory costs of 132,000. So here the lease payment, it includes the payment for the lease, and it includes the payment for the interest on the asset that the lessee pays the lessor. That's why here, I guess I didn't really explain it properly. I guess it's only it's only the present value of your MLP, and here it's 20 million versus here it's like 20 million and some things. Well, that's because when they're doing their payments, they're not only paying for the lease, they're also paying for any interest that was set into the contract. So they're paying a little bit more than the fair market value of the asset. Hope that made sense. If not, then remember here is the present value of your MLP that comes here. And then you're going to record your interest income, which is going to be a decrease in your unearned interest income and an increase in your interest income for the 1.35. So for this question, you didn't have to calculate all the table. I just did so you could see where this was coming from. But in an exam, just do up to what you need for your journal entries, and it's going to be sufficient. Then we did 3. 4, assume that the fair market value of the plane returned by Canada Airlines on December 31st, 2011, so at the end of the term, is 2,450,000. Prepare the journal entries to record the transaction. December, what's going on here is that the value of the asset that they're getting back, so the same asset that they landed like 5 years ago, its value has decreased to 2,450,000. But they thought they had an unguaranteed value of $4 million. So it was lower than what they expected. So they're going to have the loss for the difference between the two. So what's going to happen is that they're going to get back their asset at the fair market value of 2.45 million. Then they're going to have a loss on lease of 4 million minus the new value of the asset. And they're going to decrease their lease payment receivable of 4 million, which is their unguaranteed residual value. So it's the same amount as here, you know, at the end there was 4 million left, and that was supposed to be the value of the asset that they're receiving now. So that's for the lesser entries. And now we're going to do the lessee. So we're going to indicate the type of lease. We're going to indicate the type of lease. So the lessee uses ASPE. So under ASPE, for the lessee, there's the 3 criteria, and they need to fulfill one of those. So the first one is there a BPO or do they keep ownership at the end of the term, the contract? The answer is no. There's no bargain purchase option that was mentioned. 2 is the lease term more than 75% of the useful life of the asset. So the lease term is 4 years. And the useful life of the asset is 5 years. So the answer is yes. So this works, so it's going to be a capital lease for sure. But we can go and try for the third one too, see if it fulfills it. So
finishes, I just have a question with the table itself. Just
sure.
Finish this part.
Okay. So for the third one, it was, is the present value of the MLP at least 90% of the asset. So here, because we found the minimum lease payment using the present value of the minimum lease payment, so we already had the value of the minimum lease payment. It was 20 million. So the PV of the MLP is 20 million. And the FMV of the asset is also 20 million. So it's 100%. So yes. So these two criteria are fulfilled. If you had the payment amount, the MLP, and you have to find the present value of your MLP, then that amount could differ, and that's where we see that this criteria could not be filled. But in this question, it's not given, so we had to calculate it using the present value as the fair market value of the asset. Simon, it was on the table here.
Yeah. I just have a quick question on my side. It's because, how does it? Well, we did we did exercise on chapter 20 in class, and then went to the journal. We did a table first, and then we did the journal, but usually we find out the information from the table itself. But unlike this one, the January 1st journal, none of the numbers are in the table. So I'm just wondering which kind are we gonna get on the exam? And how should we, tackle this kind of problem?
Yeah, I'm used to using the formulas here to find the amount in my journal entry. And then here I just plug it. So that's how I'm more used to doing it. I would say if you do the table and you find the amount like they showed you in class, you should get the same thing, same numbers as I did. If you try it out like after or right now, and you let me know if it does the same thing, because here, it's really whichever one you're more comfortable with. Because at the end of the day, I'm sure with the table, my guess is that you're doing the same formulas as we're doing here. It's just that it's in the table.
Yes, yeah. It's like, except for the unearned interest income at the end, which is the same, that was calculated from the table. None of the other numbers are there. In class, the teacher said that the sales is the total of the reduction in lease. The lease payment receivable was the MLP, the total of that. But it is not. So.
Are you sure it was for a sales type contract? Or it was for an operating lease?
It was a sales type. It was a sales type.
Sales type?
Yeah. Because the total from the table was it's 20 million, so not 24. I'm just wondering like how we should tackle this kind of question.
Million?
Not the sell. I mean, sorry, the lease payment receivable was 20 million. not 24.
Did you have a, I guess, did you have,
Usually,
yeah. If you send me that problem so I can look at it and I'll clarify on the Facebook group, but it's like he's missing the interest portion of the lease in his answer.
I mean, the question is not the same, but I mean, usually we find out the teacher said you usually find out all the answers from the table, but you know you and then you gave me one that no, you don't find them from the table.
Yeah. All right, send me the problem. I'll look at it and I'll but it seems like they're not taking into consideration the interest portion of the lease into it. So maybe in that problem there was no interest revenue. That could happen, but that would only happen under an operating lease, which was not the case. So I'll take a look at it after. So we found out that the two criteria for the lessee under ASPE were fulfilled. So it's a capital lease. So it's like as if they bought the asset. So they're going to record an asset in their books, and they're also going to record a lease obligation in their books. So for question 6, Canada Airlines is unaware of the interest rate used by Canadair Jets to establish the minimum lease installments. Determine the amount for which the lease will be recorded. Canada Airlines has been paying an interest rate of 10% per annum for its operating loans. So what that means is they don't know the rate. Under ASPE, the rate that you use to calculate the MLPs is the lowest of the lesser or lessee rate. But since here they don't know what the lessor's rate is, they're just going to use their own. So to find the MLP for the lessee, your N stays the same. Your payment, well, I guess it's the present value of the MLP. Your payment is the same because this was in the contract. So it's still the 5,150,000. So that doesn't change. The future value is 0 because it's unguaranteed residual value. If there was a guaranteed residual value or a BPO, you would put that here. The rate is 10%, and we find the present value, which is going to be $60,327,000. Then we're going to do the journal entries for January 1st, 2008, and for December 31st, 2008. So on January 1st, 2008, they entered into the agreement. So what they gain is an leased asset for the present value of their MLP, and they also have a lease obligation of the same amount. On December 31st, 2008, they're going to be paying they're paying their what they owe, so they're paying their lease payment and executory costs. And since now they have a leased asset, they also have to depreciate the asset at the end of the year. So first, for the lease payment, we're going to have to do a table to find what's going to be the interest expense. You don't have to. Again, you can, since it's the first one, you can just take this times 10%. But for the sake of it, I'm going to do the table. So at January 1st, 2008, they have an obligation of 16 million. At December 31st, 2008, they're gonna have their first payment of 5,150,000. They're gonna take 8% interest expense on their balance in their obligation, and that's gonna be a decrease in obligation of 3.8 million. Oh, sorry, I did 8% here. It's supposed to be 10. So this is their interest rate. So here it's gonna now be 16 million minus 3, a balance of 2.8 million. And I'm gonna do the same here. What did I do? Okay, never mind. Okay, should be got it now. Okay. All right, so here, the amount at the end is 0 because there was an unguaranteed residual value. So it's okay. If there was a BPO, if there was a guaranteed residual value, then the amount at the end would be the amount of the BPO or GRV. So further payment, they're gonna have an interest expense on December 31st, 2008 of 1.6 million. They're gonna have a decrease in their lease obligation of 3.5 million. They're gonna have executory costs of 132,000. And they're gonna have a decrease in cash for the sum of all of those, which is the 5.282 that we found earlier. Then for the depreciation expense, it's quite simple under when there's an unguaranteed residual value, because you just take your book amount for the assets divided by the lease term. So if you have an unguaranteed residual value, it's book value divided by lease term. If you have a guaranteed residual value, it's the book value minus the guaranteed residual value divided by the lease term. And if you have a BPO, it's going to be the book value divided by the useful life of the asset. So the formula changes depending on which one you have at the end. Yeah, so we did all the journal entries for the lessee. Then they're asking us, using the data given above, assume for this section only that the residual value for the return aircraft was guaranteed by Canuck Airlines. Assume that the interest rates used by Canadair Jets and by Canuck Airlines are 8% and 10% respectively. So first, we're going to find out what is going to be now the MLP. And the amount at which the lease will be recorded on January 1st, 2008 by Canuck Airlines. So first, the minimum lease payment under when there's a guaranteed residual value is going to be the same. It's not going to change because we find the minimum lease payment using the lessor's information. So here, they always include the amount regardless if it's unguaranteed, guaranteed, or BPO. So the lease payment is going to be the same. Should have done my formula earlier. Then the amount at which the lease will be recorded on January 1st, well, it's going to be the present value of the MLP that we found earlier, which was the 16,327,000. plus the present value of your guaranteed residual value. So here, the 4 million is guaranteed, so we're going to find the present value of the 4 million, which we did earlier. It was a 2.7 million. Oh, no, it's not the 2.7 because they have a different rate. So Canada still doesn't know what the interest rate for Canadair is, so they're going to use their own interest rate when finding the present value. So it's going to be a rate of 10%, 4 terms, payment is 0, future value is 4 million. So it's a present value of 2.7. So the leased asset will be 18, 20, 19 million and 59,000. Any questions for question 1?
Yeah, you kind of went a little bit fast. How did you find the depreciation expense again?
Yeah, I did the leased asset value that we recorded in the books of the lessee divided by the lease term of the lease contract. So the 16.3 divided by 4 years.
Okay, and the MRP that's section C.
Yes, that's section C. It's the question. No, it's section B. It's question 7.
Oh, okay.
For December 31st, 2008.
No. I mean, what's the PV? This part, yeah, that's section C.
That's section C. So this is 8, and this is 9. All right, so I'll leave it up for you guys to write it down while I read the other problem. So Bridge Equip Limited, Bell, the lessor, agreed to lease a heavy-duty scraper on January 1st, 2015 to Montreal Engineers Limited, Mel, the lessee. Both companies use ASPE and both agreed to the terms stated below. The scraper had a 9-year life with a cost of $846,000 and a fair market value of $1,020,000. It would be leased for 7 years, after which the equipment will revert to the lessor. Bell had insisted that the residual value of $160,000 would be guaranteed by Mel and was so done. So at the end of the lease contract, Bell should receive the $160,000 either cash or, well, not cash. The value of the asset will be $160,000 for sure. So Mel has to be careful to not damage the asset too much to bring down the fair market value. Mel amortized all equipment on a straight line basis. The annual installments would commence January 1st, 2015. Both companies have a December 31st year end. Bell is normally in the business of selling equipment outright to its customers. However, Mel was unable to get the required financing from its bankers. As Mel was a regular long-time customer, Bell decided to enter into this one-time special transaction. Although Mel has agreed to pay all executory costs directly to connected parties, Bell was yet not sure about what additional costs it might incur in connection with this lease. It was particularly uncertain about legal costs and recovery of the equipment in the event of Mel going bankrupt. And finally, given the deteriorating financial condition of the lessee, Bell used a discount rate of 50%, which was considerably higher than normal rates applicable to such transactions. The lessee was aware of this rate and had agreed to it since it approximates its current incremental borrowing rates. All right. So discuss how this lease will be classified by each party. So we're going to start with Bell, the lessor. They use ASCII. So remember, for the lessor under ASCII, there's the 3 criteria that we saw. So the 3 criteria. And there's also 2 other criteria that they must fulfill first before fulfilling one of the 3. Those are, are they reasonably certain? Are they going to certain of receiving predictable payments from the lessee? So are they pretty sure that they're going to receive the money from the lessee? In this case, it says that Mel has like some problem, right? They're unable to get the required financing from their banker to buy the equipment like all their other customers. So here, like, they're not certain 100% that they're going to receive all the payments needed for that lease contract. And also, like, they increased their discount rate by 15% because they were unsure that they're going to receive all the payments. So they want to make sure that for the payments that they receive, they're going to receive more than their normal rates. So here, we can say that since the lessee was unable to get financing and that Bell used a higher interest rate, Bell is not reasonably certain of receiving predictable payments. Let me just make it so you can see everything. So here, this is not fulfilled. So if it's not fulfilled, it's an operating lease. So it's not going to be a capital lease, it's operating. So they're going to record an income and they're going to record, an income, and they're still going to have the asset in their book. We can also look at the second one. So is there any uncertainties in regards to future costs to be incurred? And it was mentioned that Bell was uncertain about legal costs and the recovery of the equipment in the event of Mel going bankrupt. So they're unsure. So here, here it's a yes. But since it's a yes, it's like a no, if that makes sense. If you said no, then this criteria passes. But since it's yes, then that's not good. So it's going to be an operating lease. So both of them are negative. So both of them makes it an operating lease. For Mel, the lessee, they also use ASCII. So we're going to look at is first the lease term, at least 75% of the useful life of the asset. The lease term is 7 years. And the life of the asset is 9. So it is 77%. So this is fulfilled, yes. So it's going to be an capital lease. I always get mixed up with operating and capital for some reason, but it's a capital lease. So they're going to have an asset in their books. The second one is there a DPO or do they keep ownership at the end? And the answer is no. So this one is not fulfilled, but that's okay because this one is. And 3 is a present value of the minimum lease payment at least 90% of the fair market value of the asset. So we can find it by doing, so here again, we don't have the amount of payment that they're making each year. So we're gonna have to calculate it, and we're gonna calculate it using the present value of the MLP as the fair market value of 1,020,000. So here I'm gonna have N of 7, a future value of 160,000, because there's a guaranteed residual value, and it's the lessee. The present value is 1,020,000, and the rate is 15%. The payment amount is and here is it end of period or beginning of the period? It is. The payments are made on January 1st, 2015. So here it's beginning of the period. So we have to put 1 or on your financial calculator, make sure that you switch it to beginning mode instead of ending mode. So you'll have payments of 200,000, and the present value of the payments are 1,020,000. So the PV of the MLP is 1,020,000, and the fair market value is 1,020,000. So it's 100%. So yes. Technically, like in your exam, you can just stop here and you're fine, because you only need to fulfill one of the 3. I do the 3 so you can see how it's calculated, and anyways, that number is not lost because we're going to use it in future questions for this question. But just so if you want to go a little bit faster, you can just look at this one first because it's faster to check and see if it's 75% or more. And then, so here for the lessee is going to be a capital lease. So like we did in the previous question. So second, determine the amount of the annual installment which Ben has set for the lease. So what's the MLP amount? And we just calculated here. It's a 617. Here, it doesn't really matter because they're using both the same rates, right? The lessee and the lessor are using both 15%. But if they didn't, you would have had to recalculate your payment amount using the lessor's rate. For 3, prepare the lease related journal entry on January 1st, 2015 in the accounting books of the lessor and the lessee. So I'm going to start with the lessor. So for them, it's an operating lease. So on January 1st, they're receiving their first payment from the lessee, and they're going to record it as unearned lease rental revenue. So it's just going to be rental revenue at December 31st when their year is done. So they don't have to record a sale, a COGS, decrease in inventory. Their asset is still in there, and they're just earning revenue from the use of that asset from the lessee. So they're going to receive cash, the 200,000, and they're going to record an unearned lease rental revenue of the same amount because the payment was done at the beginning of the year. On January 1st, 2015, for the lessee, for them, it's a capital lease. So they're gonna have to record an asset, and they're gonna have to record an obligation, and they have to record their payment of that obligation on January 1st. So if we do the table, I mean, it's not really required. We could do the table just for fun. Your date, MLP, 15%, reduction, and obligation. So on January 1st, 2015, they have an obligation of $120,000. So that's the present value of the minimum lease payment, which is the same as the lesser because they're using the same rate. The other question, it was different here because they weren't using the same rate. And they also make a payment on January 1st, 2015 of the $200,617. They're taking a 15% of their book value. And there is a reduction of $47,000 in, no, sorry, there's no interest. There's no interest because the year hasn't passed yet. So that full amount goes straight to a decrease in the obligation. You're going to record interest only after 1 year has passed. Sorry, that's my bad. I got too excited. So on December 31st, 2015, you're going to have your 15% of your book balance as an interest expense. And that's going to not come and reduce your obligation yet. It's only going to come and reduce on January 1st, 2016. I guess I should have just put January 1st here, but the reduction that's going to happen is that you're going to have an interest payable on December 31st, 2015. And when you actually pay it, it comes and reduce your obligation amount. So it's going to be reduced by $77,000 to get to $741,000. You can just put it all on the same line. I don't know why I did that. I guess to make it easier in the future journal entries, but could have just done this, and put Chapman first. And that's for the second year. And you can continue all the way down till year 7, which is going to be 2015, 2016. 2022, this year. And at the end here, you should have your guaranteed residual value of $160,000. So for the journal entry, they record their leased assets as the present value of the minimum lease payment. And they're going to have a lease obligation of the same amount. Then on the same date, they're going to have a payment of that lease obligation. So it's going to come and reduce it, reduce your cash by the $200,000. And that's it for the entry on January 1st. My God, okay. Sorry, my cat made okay. Then on December 31st, 2015, we're going to do the entries for both. So first for the lesser, what's going to happen is that they're going to recognize their unearned rental revenue into lease rental revenue for the year. And they're also going to depreciate the asset in their books. So first, recognize the lease rental revenue. And that amount is going to be the amount cash that they receive at $200,000 or whatever you put here in the unearned. And they're going to depreciate their asset. And the asset is going to be the cost of $846,000 divided by the useful life of 9 years. So for them, it's like normal. There's nothing like special because of the lease agreement. They just do it as they did before. For the lessee, they're going to record a depreciation expense and an interest expense because a year has passed on the lease, so they accumulated an interest expense of 15% on the lease contract. So first, the depreciation expense. So the amount is the cost of the asset, so the 1,020,000 minus the guaranteed residual value of 160,000 divided by the terms of the contract, which is 7 years. So here, since it's a guaranteed residual value, it's the book value. Well, I guess the cost of the cost minus the guaranteed residual value divided by the lease terms. Then the interest expense and interest payable, because they're only going to pay it on January 1st, 2016, is 122,000 here that we calculated in the table. Then the journal entry for January 1st, 2016 for books. The lessor is going to have an unearned, like before, they're going to get the cash and they're going to record an unearned lease rental revenue of the 200,000. Same thing here. And for the lessee, they're going to have a reduction in their obligation. They're also going to have a reduction in their interest payable. And they're going to have a cash amount that they pay. The cash amount is the 200,000. The interest payable is the 122,000 that we reported the day before. And the obligation amount is the difference between the two of 77,000, or the amount here that we put in the table. Then assume that the fair market value of the scraper returned by mail on December 31st, 2022 is 138,000. Prepare the journal entry to record this transaction in the accounting book of the lessee. So for the lessee, so the lessee had to pay back for sure 160,000, but they didn't. The fair market of the value of the asset when they give it back is 138,000. So you want to first get rid of your obligation of your asset and of the accumulated depreciation, and then you want to record your loss on the lease, and that loss you're going to have to pay it back to the lessor cash. So first, to get rid of the lease assets, you're going to have to remove your accumulated depreciation, which is the 122,000 times 7, or I guess again, it goes, no, okay, never mind. So it's the 122,857 times 7 years. And then you get rid of your lease obligation, which should have a balance of 160,000, which was your guaranteed residual value, right? So at the end here, your lease obligation had the book value of 160K. And your lease assets, which had a cost of $1,020,000, is out of your books. Then to record the loss, you're going to have a loss on lease equipment of 160,000 minus the amount of here of 138,000, and that you're going to pay cash to Canada, to the lessor. So here. Then finally, for the last one, regardless of your answer to question 1 above, I assume for this question only that this lease had been classified as a sales type lease by Bell. Prepare the entry to record the lease transaction in the books of Bell on January 1st, 2015. So here we're going to record as if the 2 criteria earlier were passed, and since here the criteria is passed for the lessee for a capital lease, it will be the same for the lessor. So here we're recording a COGS, inventory, sales amount. We're going to record a lease receivable, and then we're going to record unearned interest. So first, my lease payments receivable. The amount I'm going to take is my minimum lease payment times the lease number of lease terms plus my guaranteed residual value. So it's going to be my 200,617 times 7 years plus 160,000. My cost of goods sold is, what is it already? It's the present value it's your book value minus the PV of your guaranteed residual value. So here it's going to be 846,000 minus PV of 15,760. Yeah. So here what I did 846,000 minus. Yeah, I think we found it earlier. No, we didn't. Well, the PV, okay. The PV of the GRV is $91,000. That doesn't seem right. Oh, got confused with the other question. It's 7 here instead of 4. So the present value of the guaranteed residual value is 60,000. So you subtract that from your book value, and it gives you a COGS of 785. The reason why we subtract it is that at the end you're going to get back your asset for $160,000. So that present value of your guaranteed 160K shouldn't be included in your COGS. Then sales is going to be your 1,020,000 minus the 60,000. Yeah. Inventory is your book value of the asset, which is 846. And then you have unearned interest income of the difference between the two. Of 544,000, which should be, when you complete this year, it should be the sum of all of this together, all the interest expense. And that's it for the question 2 and for the tutorial. So any questions? I know it's a lot of stuff to remember, a lot of steps. So if you have any questions, just let me know.